Welcome to Mission Oriented, a VeteranCrowd podcast that showcases veteran talent from both the private and public sectors. Their impact is everywhere. We are here to uncover it. Here's your host, Bob Louthen.
So Brandon Shelton founded TFX Capital in 2015 with the belief that the best entrepreneurs come from those who have served. As a managing partner, he's leading the firm's investment strategy, the focus on pre-Series A and Series A B2B technology companies. He is a University of Richmond Spider grad, got his MBA at Duke, served in the best branch of the military, the Army. We can argue about which specialty within Brandon was superior, but anyway, welcome to the program. You're no stranger. Welcome to the Mission Oriented podcast.
Hey, thanks, Bob. Glad to be back on and glad to see this podcast really taking off, and always glad to talk with you.
Yeah, it's good. Like I say, you're no stranger to this discussion. We've been talking about veteran led businesses for a long time. The first question I've got to ask you is, and I hope you concur with me, I think that finally, there really is a wave of money coming into the veteran space. Am I reading the tea leaves the same way? And you were a pioneer in it, but when we were in, I guess when Kevin and I were in San Francisco back in the early part of the year, there's a lot more people focused on this space now.
Yeah, I would agree. I think that if you go back and look at some of our original plans and some of our original PowerPoints, one of the things we aspire to do is to direct, either through our own or inspire others to direct more capital at this athlete class. And so, yeah, I think we count, 24 copycat, near peer, different flavors of it. And you should, I think if you're a former military and you have that networking license and that networking membership, not all veterans are the same, and not all businesses are the same. And so every investor is going to have a different perspective and specialty and network. And so you should have more options than one, more options than two. I think, though, if you put all the AUM, so all the assets under management of these handful of smaller funds, it still doesn't even register a blip. It's it's capital dust within the venture capital industry. So, arguably 10% of all startups, if they were to be pari passu with 10% of all small businesses in the United States are owned and run by a military veteran, you arguably have all 10% of all the activity out there. But yet, the venture industry is anywhere from $150 billion to a $300 billion per annum industry. We don't even come even close. So while I'm happy there's more doors, there's more deliberate networking and more, I think, crosstalk, which is great for our tribe. I think more is needed. So it's pretty exciting. And I would also build on that. The thing that's happening, which is not veteran directed, but is pulling on that network as well, is this, I think, long overdue and much needed acceleration of all things defense and national security investing. And so if you're investing in this space, not to say someone who didn't serve in the intelligence community or national security apparatus or the military doesn't know how to build dual use tech or defense tech, I just think there's a real benefit to having been on the customer side a lot of times. So whether you were a junior person or a junior staffer or junior GS, so you're seeing compounding levels of capital. Just in the last, 5 years, I think the Air Force has put well over $2 billion into early stage startups in the form of grants. That, again, the Air Force every 12 months is the world's largest seed investor. So I just think that is also happening in parallel, Bob, since you and I first met in May of this month, May of 2015, 8 years ago, when you came down to Charlotte, as we were sort of brainstorming this idea. But I think those two things moving in tandem, it's just, I think, is acting as a bit of a flywheel. More and more folks are coming out of the military, going into startups. More and more defense startups, dual use tech startups are being created and are scaled. More venture dollars are starting to understand how to underwrite a software company or software hardware company that serves both national security and the private sector. So I don't think it's the veteran population that's getting bigger. I just think there's an awakening happening on a number of fronts that I think are reinforcing our tribe and our, what's our role to play.
Do you think that the venture capital industry is kind of collegial, or is it competitive at this stage in time? I mean, co-investors, or is everybody out, trying to find the best deal?
I do believe it's the latter. I think at the end of the day, venture capital is very much a very sharp elbow, it rewards selfish activity a lot of times. And it's no different than private equity, investment banking, and others. So for us, how do you operate as someone who's trying to make large returns for your investors? As you know, most early stage investors, let's just call that from seed to series, maybe BC. You need a handful of firms coming together. You're always in a syndicate environment, so you do want to play nice. So I think there is partnership there. But just as a firm, and hearing the stories and observing the stories of our portfolio companies, at the end of the day, a good chunk of those in the venture capital industry, go with the wind, right? They don't necessarily they're either the individual at that firm or the firm itself. They invest in clubs, or they invest in momentum, and they invest in, well, if they're in, I'm in. And they assume that larger firm has done the diligence. And what we're finding is that's not necessarily true all the time. So just think that the incentives of the allocators to the venture funds is to make a lot of money really, really fast, take high risk for the high returns that they want. And we just wrote a thought leadership piece this month on this. What we've been hearing over the last few years, this is before the pandemic and since the pandemic, and definitely recently, is a lot of endowments and institutional investors, RIAs, family offices who allocate, and pension funds who allocate to VC funds. They were taking issue with you're spending the money too fast, and you're coming right back to market for another fund. You are not really doing a lot of diligence, or how are you establishing that valuation? If you have no revenue, and you're 1 year old, but you get a $50 million valuation, a lot of people scratch their heads, who are CFAs and other professional finance allocators in the industry. So I think we at the moment are paying the price of that greed and that sort of sharp elbowedness right now, because the entire industry is essentially paused, if not resetting. And when you look at the numbers, and let's say 2019, 20, and again, a lot of the numbers in their industry are directional at best, because there's a lot of private market transactions. You can't really rely on some of the reporting from PitchBook and others. But if you take it at the direction, and you look at like 18, 19, 20, and then you look at 21, I mean, the lid was taken off. And I think, again, starting kind of April, May of 2022, definitely to present, interest rates, I understand that environment, but you essentially have the tech M&A market has been closed for almost a year. That shuts off the top end liquidity if you're IPOing or M&A. Then and then you have public equity. So if you look at venture-backed software companies who IPO'd over the last couple of years, most of them are underwater in terms of their IPO price versus now, because as the public market investors started looking at lack of EBITDA, lack of scale, lack of operational leverage in some of these startups, they're sort of like, wow, that's not really worth the amount that it IPO'd for. So when those two things happen, when you start walking that down the Series C, B, A, and then where we play kind of pre-A, early A, how do you mark evaluation? So you're seeing a lot of funds now who are audited, and the auditor saying you have to now take your marks down, which everything was up and to the right, because it was fast, go over the last couple of years. And so all those forces working together are causing a lot of people who are more momentum investors, invest more in kind of fads or markets or something like that. They're pausing. Whereas for us, we gain conviction on the founders and their domain expertise. We need to account for the market, account for their business plan, account for the risks involved, for sure. But this is the time you should be stepping forward. So you see in the current market, to your original question, is it greed and everything else? There are great venture investors out there who really care about the founders and work their butts off for those founders, and they're there in the downtime, in the worst times. They're there in the good times. At the end of the day, the founders are the ones taking the risks. The VCs are the ones writing the checks. We all try to add value in other ways, introductions, advice, connections, talent. I got it. We're all sort of playing the same hymnal there. But I think the really more operationally sound, empathetic, professional venture capital firm can balance the two forces, right? The need to care and feed and support the founders and their teams and their journeys, while at the same time having an eye on creating, meaningful returns for their investors. I think what denominates both of those, balancing the two, is time. You've got to have patience. So a lot of the people I talk to, especially recently, don't even understand that VC funds are 10-year vehicles. I've been to a couple meetings just in the last 30 days. They didn't understand that. Okay, well, on paper, I have 5 years to invest that capital. Can you, as a smaller fund, I can go a little bit faster because I don't need all that time to be thoughtful. But in terms of your execution rate, we've been executing about a deal a quarter, regardless if it's a pandemic, good market or bad market, because of our disciplined approach. So that's, I think that's where you're seeing the reset happening, is sort of this go, prioritizing speed over all else. Push the capital out as fast as possible, and then come back to market, raise an even bigger fund. Push that out as fast as possible, and I'll come back to market rate. I just think that got really out of control in late 20 and all of 21. And now you're seeing the necessary pausing of that as we balance these forces, right? Like at the end of the day, it's founders, it's their livelihoods, it's their risk and their teams navigating it, versus the need to generate the returns on some, a timeline basis. So long answer to your short question, but I've definitely personally, coming from the military and coming from a family, from Virginia, that values, morals, value, all that stuff that are really important. How do you couple that with the need to make, capitalistic and really high returns? I mean, venture's not here for a 1x, 2x return profile, but how do you balance those two while being patient and empathetic with your founders?
Okay, so from your standpoint, you're kind of taking a steady approach to it, staying at it. What has changed in the way you look at a deal today versus the way you would have looked at it, say 18, 24 months ago, because of the rising interest rates and that sort of thing? I mean, is there a different posture, or are you just keep at the fundamentals?
I would say we keep to the fundamentals, I think, but you have to account for the market. You can't just ignore the forces. So I think for us, earlier stage investor, generally B2B, B2G. On the B2B front, again, hard if you're selling cybersecurity to a company, HR software, financial services software to a company, that's sometimes very, very challenging, right? It's a Fortune 500, it's a Fortune 250. So what we try to account for is how are the budgets lining up for your target customer? Will they have the freedom to have POCs? Will they have the freedom to, okay, yep, I'm going to try your phase one of your product and see if it works? Because if those industries or those particular companies have a bad exposure to interest rates because of their product, their customer, their lending, their borrowing, that's got to be accounted for in your risk profile. Like, you may not have any sales in 2023. So if I then reconcile that with how much capital you're raising versus how much you want to spend, and you start doing the math on like the next 12 months roadmap, you start to understand like, this is going to be a problem, right? I think that's one way on the interest rates. I think the second thing is just around, will there be investors active again? So for us, we're trying to partner, especially with pre-Series A companies, get them fit, support them, and get them ready, right? Ready to go up to that curve to a Series A investor. Well, most Series A investors right now, in our experience, are just like they were in Q2 of 20 in the lockdown. They're taking all the meetings, but they're not necessarily executing because they're waiting. Their investment committees or others, or they're I wouldn't say they're wasting people's time, but like they're unsure of what they want to do. And so, okay, then it's like a pathway of how, if we partner with this company now, invest now, again, timeline on customer, but timeline on that pathway to that next capital raising ridgeline. Like, sometimes the founders will come to us and go, I just need this amount of money now, and in 6 months I'm going to be at 5 million ARR, and then we'll go raise this. You have to then reconcile that timeline based on the assumptions. Like, will you have enough proof points by the time that you run out of money and or are ready for that next.
If you were a Series A, investor right now, would you be sort of a contrarian? Would you, rather than, withholding and sitting back? Do you think that's unwise? Should they actually be taking advantage of this opportunity to invest and continue to invest?
100%. If we were much bigger, had more freedom of movement, I think we would accelerate our deal making.
You've got an interesting chart on your LinkedIn profile, by the way, that you and I were discussing before. And I think this speaks to that a little bit.
I think we're going to look back. I think I'll bet a beer on it or something. But I think when we go to 2025, 26, 27, we look back to the quote vintages. So I'll use some VC speak. So I think companies that are either started or get their earlier funding rounds in 2023 at a correct valuation that's fair. I think those returns for the founders and those earlier investors will be top decile.
That's kind of counterintuitive from the founder standpoint, because they're sitting there saying, well, I'm getting a lower valuation for the same amount of money. Make the argument that that's not necessarily a bad thing for the founder that you just pitched.
Sure. So, I experience this often. We try to do our best to explain to them. Most founders, I'm a founder as well. We're all got a few screws loose. We're all a little bit stubborn, a little bit paranoid, right? There's a lot of, I've talked about this a lot. There's a lot of information asymmetry in venture. There's a lot of bad behavior in venture. So that notoriety gets passed around founders. So the moment they come across from you, they're like, ooh, it's like going to a doctor that you don't like, and he or she's going to give you bad news or something, and they have all this information. So I think that when you do the historical math, just take the last 10 years, 20 years, there's a number of studies out there that show this. If you don't grovel over your early stage valuation too much, in the long arc, remember these are 5 to 7 and 10-year journeys for most founders. They don't realize that. They're thinking very tactically, this round, next 6 months, next 12 months. You're haggling over very little. And so we know a number of funds who set a investment thesis that they only want to invest in second time, third time founders. And a core reason is this, that they don't have to exert a lot of pain in educational conversations with founders because they've done it before. And they understand, like, we shouldn't be arguing in the first 12, 24 months. We should find a fair price, fair structure of the investment vehicle. But like you're turning cycles on very small topics in the grand scheme of things, right? So I also try to point out to founders that the earlier stage investors are right there with you. We're generally pari passu with you. And so when you think long-term review, it's not that I'm taking from you, we are together. And so we've got to get on down a path and start getting to those execution points and those proof points so that we all don't get diluted second round, third round, 9th round, 12th round. Some of the things that can happen in a market like this, where there's a down round, there's a pay to play round, like some of the quote venture capital goodies start to come out. Think the balance of power moves back from the founders, where it was in 21 and early 22, it moves to the investors, right? And they start putting things into your term sheets that you're not really happy with and stuff like that. But I think if you find a fair investor, a group of investors, and both parties are transparent, quickly come together on, yep, it's about this, it's about that. Stop trying to equate your hopes and dreams into that funding round, but find it, up front, and understand pre-Series A land, those investors, whether they be individuals or family offices or small VCs like us, it is maximum risk. You have a 90% failure rate probability hanging over your head. And so if we're willing to step forward and take a massive risk on you super early on, there should be a partnership mentality as you go forward. So yeah, there's a number of studies that you can look at, but yeah, in my opinion, pre-Series A, Series A investors should be quite active right now. Founders, if you need to raise capital, go do it, but pick a smaller amount than your aspirational bigger amount. That's something we've been telling folks. That helps protect dilution, Bob, as you know.
Mm-hmm.
It also lessens the time. That's something we've always struggled with, is that the amount of time, not only for us to raise capital, we're trying to raise our third fund now, but for founders to raise capital, it is incredibly time consuming. These startups don't have like an investor relations person who handles this. Or a lot of them don't even have CFOs to handle this. It's diluting the time to execute. So the second, 4th, 10th exploratory call with a VC, very challenging. So if you lower the amount that you're raising and just strictly raise from angels, just canvas your network. And you're going to, that's just hey, I want 2 million. So I'm trying to, or 3 million. So I need to find a lead investor. In this market, that could take a while. And that time that you invest there, there's an opportunity cost away from the business, which can attract investors later. So at the end of the day, I think one of the things that you're probing at is venture capital and represents a large period of a time. So it's everything from where people start their business till pre-IPO 1,000-person business. But generally speaking, if you're in the first 3 years, 4 years of a startup's journey as an investor, you're making the investment based on years from now. It should not be one-to-one correlated to what the Federal Reserve is going to do in June. It should not be, I have a wedding to pay for in the fall, or any of these type of other, some of the angel investor type stuff, right? And then for a VC, that's what you should also be thinking of. So in the investment committees and others, you don't want to spray and pray. You want to be thoughtful, be disciplined, go through your diligence steps, but you should be gaining conviction. What proof is there? And really, who are these people? Are they domain experts? Could they be doing something else? Why are they still convicted, even with, 1 year in, 2 year in, 3 year in? What are they seeing? What do they know? They're the experts, and gain your conviction there. But it's really a bet on the economy and that industry and that startup years from now, right? So that harkens to that chart, and it's proven itself. 2001, 2, 3 kind of recovery from the dot-com. If you look at 8, 9, 10 from the great financial crisis, I do think you're going to see great vintages out of 23. I will make one caveat. There's a little bit of some commentary starting to come out of the venture capital community that all the price points and price rounds that were done in 2021, if you're coming back to market right now, you are most likely going to be
taking a down round,
which is going to hurt you from a dilution.
The Mission Oriented Podcast is sponsored by TFX Capital Partners. TFX Capital Partners is a full-service mergers and acquisitions advisory firm specializing in the confidential sale and acquisition of privately owned mid-tier businesses. At TFX Capital Partners, we believe that our veterans continue to lead impactful lives as civic and business leaders. Their leadership and management skills, hardened in the crucible of the military, are key drivers of success. Veterans are mentally tough team players and creative problem solvers imbued with a heightened sense of ethics and personal accountability. TFX Capital Partners is committed to supporting veteran business owners throughout the life of their companies, building professional relationships and networks, advising on capital formation, mergers, and acquisitions. Contact the veterans on our team, Matt Kane, Ross Harris, and Bob Louthen at transactcapital.com. So you're listening to the Mission Oriented Podcast on the VeteranCrowd Network. Welcome back. My guest is Brandon Shelton of TFX Capital. Brandon, I want to go into a little coaching session here. And I'm going to pretend that I'm a veteran raising capital or thinking about raising capital over the next 6 months, a year, early stage company. What do I need to be thinking about? What do I need to be doing? What's your 2 or 3 bits of wisdom here?
Yep. Well, I'll start off with the preference that you're a veteran. And so I would say there's some TBD chunk percentage grouping of all veterans trying to start a business that probably should not be doing it. And what I mean by that is they're starting a business because they personally didn't fulfill their aspirations and missions in their corporate endeavor post-service. So if you're starting that business because you don't want to go work for the man or the woman, you don't like your corporate gig, you did 12 months there, 20, it just doesn't fulfill you. Yeah, a startup can electrify you, can get your juices going and stuff like that. But when you start down the path of starting a small business and then you start taking on outside capital, I've seen this quite a few times already. You get yourself to that 3-4 year mark and you're like, this is not what I wanted to be doing. This is causing mental, physical duress. The financial pain of this is enormous. And so what I thought I would find is not really here. So first step, first checklist, first milestones, check yourself. Do you feel in your heart like you can't sleep unless you start this business? It's not that someone's daring you. It's not that are you strong enough? Are you good enough? Those type of things. And I operate with a chip on my shoulder, so I can relate to those sort of, you can't do it. Well, now I definitely want to do it mentality. Make sure you're not fleeing something. Make sure you're in flight towards something. And because why? There's 3 reasons. Number one is you need that purpose to still you and propel you in those dark moments that you're guaranteed to have in those first 36 months. Number two, you will attract the best possible advisors, discounted vendors, teammates, things you can't afford. You get them rallied around your mission because they're like, I don't necessarily agree with Bob's doing, but holy cow, this guy is purpose driven. Like he sees it and I'm inspired. So when you look at all the great entrepreneurs, Steve Jobs and Elon Musk and the ones we talk about now, yeah, they have personality issues and leadership defaults and stuff like that. But like people are rallied to them. In the military, there's the same similar, right? What leaders, not their rank, but leaders did you gravitate towards? They're the ones who believe it in their core. The third thing is I think investors like that too, right? And so if you are a domain expert, you know this problem cold, not because you studied it at HBS or because you've been Google searching and figured it out, or hey, this is me and my 3 classmates were coming together to do something together because it'd be fun to work together. Nothing wrong with those businesses, but like the really astute investor that you really want is like, wow, I'm sitting across from an expert on this topic. Now, they may not understand how to start a venture business. They may not understand how to run a 4-person company. That's all learnable. But what's not learnable is, wow, they are really locked onto this. And so, Bob, I would say, you know, I'm proud to say, I would say all 18 of the founding groups that we invested in are this way. Now, they're all sometimes challenging to deal with and stuff like that, but they crossed that chasm where they felt like they should be doing that.
Have they found product market fit before they come to you, or is there some pivoting that takes place after your investment?
Yeah, it's a great question. I understand why that phrase product market fit exists, and I don't want to disrespect it, but I just think it's unique to that individuals or the individuals and their company. It can mean different things for different people. So have they found the point where 1 pound of effort equals 2 pounds of output, or 1 + 1 = 4, or whatever you want to say, where it's starting to scale and evolve? No, we are generally left a bank. So we're generally trying to help them get to that point. This is the perils of early stage investing. So no, we don't have the luxury of going, oh, this is beautiful, this works, we get front seat, we're going to invest. We're trying to say, can they get there? What do they need? Can we help them get there? So yeah, we have a couple of companies. I mean, we've had 4 exits, but we definitely have, like, I would say right now, 2 companies that are on that path. One very specifically, and it's pretty amazing to watch. And then you juxtapose that with like an early stage company that just is generally 2 people, 7 people, 9 people working their butts off for $100K in revenue total, like $300K for the year, $500K for the year. You know what I'm saying? You can understand that landscape that they're trying to get to those inflection points. Once you get to those inflection points, the math problem is different, because which investors do you want? Do you want to get a line of credit? Like your financing needs, you get more optionality. But the goal to get there is like, wow, the thing is working, right? It may not work forever. It may not work consistently. It may not scale in a healthy manner. And those are new problems to have, but they're fundamentally better nature problems than we have 2 months of runway. We have 1 week of runway. We got to stay alive. We got to take pay cuts. We've got to riff. So long answer, short question, but we're generally in the earlier stages.
Brandon, one of the things that I've always talked about is knowing, what your weaknesses are. One of my favorite quotes is Russell Wilson's grandmother said, let one of your strengths be, your weaknesses. But I also believe that I shouldn't go work on my weaknesses. I should go find somebody that complement me, because if I go work on my weaknesses, I'll just have stronger weaknesses, right? So let's talk about the importance of team.
Yeah. So I would say 70% of our investment thesis or underwriting standards are the team. So, and it has to, and we have our own biases, and we're always thinking about that, right? How do you filter out the biases? And there's lots of ways now we're developing that, right? One of the tools that we've been using from day one is, to your strengths question, is the Gallup Strength Finder exercise. So we have one of our internal executive coaches who's former military as well. And when we go to formal diligence, if it's a two-person founder, a 3-person founder, we say, look, you bring those 2 or 3. If you want to bring 1 or 2 others, whatever represents their early phases of your leadership team, take the test. It's 20 minutes online. and there's a lot of, multi-million data point history on all of this. And then she meets the team, and then she debriefs the team, and then she debriefs us, what she's finding and whatnot. And she's been doing that methodically through all 18 of her teams. And of course, they hand back the information to the founders as well.
The Gallup test doesn't, separate out some kind of a total loser. I mean, in reality, it just kind of puts you where you're supposed to be, what your strengths are and what you're good at. Is that sort of the output?
Yeah. So what I like about it is where Myers-Briggs, if they have that, the founders have ever done that. Can you tell me what your score is? Right. What I like about Gallup is it really measures the interoperability of the team at that moment.
Interesting.
So if you go back to some old Stanford GSB interviews with like Mark Andreessen and Peter Thiel and some of they will actually comment on this. And this is where I had I heard it first back in 2015. I was like, well, what tools can we use to empirically overlay on top of our gut reaction to the founders? Ooh, I like this. Ooh, I know this problem. Ooh, I like these people. Ooh, we know a bunch of the same people. And that was one of the tools. And I will tell you right now, you see very clearly where when certain founders leave or their issues, and you start to understand, well, the team became imbalanced. Like what's going on here? You can go back.
Gallup actually takes the team as a whole as opposed to the individuals. Then
now, the individuals are each listed, and then you measure with the team. And so it has 4 quadrants, and you start to see like relationships and influencing and others. And it's not just their top 5 strengths. It's what they call them. They're not weaknesses, but they're least 5 strengths, right? 30, 34, yeah. Whatever it is. So you just start to see what it is. And actually we're doing another study now because we're at 18 companies, just trying to stack it up. We've ourselves taken this, to guard for bias. I'm in your camp in terms of playing to your strengths. Generally our founders are a little bit older, 30s, 40s, 50s, this type of thing. Where the brain is not as malleable, and certain behaviors and styles and personalities are a bit more codified. So the question we ask ourselves is, okay, I like everything I'm seeing. I like this team. Where are their gaps, and how are they as a team? Whether it be a capability gap or, to your point, of weakness, how will they plan to solve for that over time, right? That's a great question, right? Org chart, org planning. And if founders can't do that, that's a red flag. And then the second question is, are they in the right season of their career? And that's a hard question, because if they had started the business maybe 2 years earlier, maybe that would have been better timing for how they make decisions and whatnot. Or on paper, and this is the risk if you invest just based on pedigree, on paper, they look like they should be the perfect founder for this, but they're not because of where they are in life, some of the personal friction and, the things under the water, if you will, the duck under the water, what's going on, that type of thing in their personal life. So that's a hard question. Obviously, you don't want to probe too much on their personal lives when you're talking to founders, but that's interesting. I'd say the last comment on this, and I really, really believe this, is that I think that starting a business of any shape or size is an exciting, but also highly irritating and fatiguing journey. And that F word, that founder word, will never leave you. And whether your business is working or not working, whether you have a big staff and you're highly profitable or you're not, you're always thinking about that business. And so that takes a toll on veterans, on Navy SEALs and pilots. I don't care how many times you've been deployed and stuff. It just doesn't stop. And so I think from an emotional, physical, mental, and definitely financial standpoint, you need to steel yourself, right? This is a long 5 to 7 year journey. And that's why we started our firm. It's like, okay, if that's truly the nature of this long grinding bit with lots of peril and lots of failure rates and stuff like that, I want to make sure at least one of these leaders in that founding team has done something fundamentally harder than this startup. Like, I don't want your worst day professionally to happen with my investor capital. That's sort of the thing we talk about internally. And you can get this in lots of places. I would also add not just veterans, I would say immigrants. I would also say college athletes. And really a lot of times it's because of the age, right? When were you exposed to trauma or challenges, physical, mental, whatever? And, in the military, 18 to 25, right? That brain's not firmly formed, very impressionable. So you know that you can fundamentally hang in there longer. You can take more body blows, but you're still kind of declining, right? So we're also trying to measure that a little bit and say, okay, we don't want to invest in solo founder teams because of this. I need you to have a person next to you or another person next to you, and the three of you should lean on each other in those early years, right? And another one is that we try to steer away from related teams, brothers, spouses, and that's a hard question. That's a hard thing for some of these folks, right? Because if they get a divorce or some old stuff from their childhood comes up or whatever, it's going to throw off this dynamic. That core, that founding team plus one or two other leaders, it's not necessarily the board or the lead investor should carry that water. It's really that team that's in the fight. That is most important. So we spend a lot of time trying to measure, analyze, and assess that 3 people, 5 people, 7 people. And then every 6 months, and if we reinvest, we're trying to measure it again. Who is it? Are they making the best decisions possible, right? Are they? But you will see it over time. You'll see these founders fatigue, and they'll tell you, like, man, I'm smoked. And so again, we bring in our own mental wellness resources and others, and we advocate, look, just showing up to your startup and grinding is not enough. You have got to take, like in the military, as you know, there's a beauty that most, I don't know what, 90% of the military is this way, U.S. military, you get up most days and do exercise, most roles. There's a beauty in that, right? And so you've got to be working below the body, not just below the neck, not just what's above the neck, we say. And so you have to be working what's above the neck, not just below the neck. And so if you're drinking a bunch of alcohol and you're pulling all-nighters and you're not focused on sleep and you're not exercising every day and you're super overweight and all this other stuff and these unhealthy habits, you mentally are going to make worse decisions. So the best thing you can do as we hunt for that inflection point, the product market fit, the revenue growth, the things we all want, garner more investment, garner more capital, more team, scale. The best thing you can do every single day is be disciplined, and it's in you. You were exposed to it in the military, and then you can inspire your co-founders who maybe didn't serve in the military. They come from other walks of life every day, and you can make it part of your culture. Time off, da 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 da. So we've really been hitting on that, especially since the pandemic lockdown. We're blessed to have someone like Dr. Ben Michael Ellis, who's on our website, leading fireside chat and presenting studies and others. So it's not just whimsical, like, oh, focus on your breathing, or oh, focus on this. No, more and more discussion is happening around this 5 to 7 to 8 year journey is very challenging, especially if you take on outside capital. That F word really impacts you. So I'm just saying, trying to account for all of that, imagine all that in an early stage company, we just have some preferences. Like, can they withstand the pain? Ooh, how long are these sales cycles? Ooh, how daunting is this thing they're trying to do or fix or create? Yep. And are they in the right season of their career to do the thing? And then there's all the other stuff that other VCs would tell you. Are they coachable? Do I like them? What is it? Can I drive in a car for 4 hours with? All this other type of stuff, right? You can assess all that, but we're trying to do our best to bring some of those measurement tools early to answer the question. The other way you could do it, which some VC firms do it, is you don't care. It's a check. And so a check's a check. So I'm just going to have, instead of having 4 of you where I spend time.
And I do think there's some VCs that would have been better putting $50,000 out 100 times than trying to put $5 million one time.
It's a different model, right? So, and that way they can ignore all this, right? They can say, look, it's just a check. I'm just a financier. I don't want to be exposed to all that stuff. And if you blow yourself up and you have, a mental breakdown or anything, I'm sorry, that's terrible. But I'm saying, I have 20 of you. I just need one of you to make it through, right? So just a different model.
Well, Brandon, folks, there you have it. Brandon and Shelton, thank you so much for being a guest on the Mission Oriented Podcast. You've always got a lot to share, interesting stuff. Best shout out to you, Kevin, and everybody down there in Charlotte. Thank you so much for appearing today.
Yeah, thanks for having me. TFXCap.com is our website. I would tell you, look at any of our companies. I don't care if you're military or not. If anyone listening to the podcast can help any of these companies, reach out because they're all doing something pretty awesome.
Thank you. We'll put links to how you can get in touch with Brandon, also to the website. And if I can get your permission, we might also post that chart.
It's not mine. I don't know where it comes from.
Okay. Well, we'll share that. We'll share that chart as well. Hey, you've been listening to the Mission Oriented Podcast on the Veteran Crowd Network. Again, my guest has been Brandon Shelton, University of Richmond, Duke grad Army veteran Brandon. Bravo Zulu to you for your performance today. Thanks so much. And that's a wrap.
Thank you for listening to Mission Oriented. Make sure to hit the subscribe button and you won't miss an episode. To learn more about Mission Oriented and the Veteran Crowd Network, visit us at www.veterancrowdnetwork.com.